All right, welcome to day one of our 50-day journey. We are here to build a real, no-bluff financial mindset. So forget all the confusing jargon, forget the get-rich-quick stuff. We're going to give you clear, actionable knowledge so you can finally take control of your money, and we're starting right now.
So let's kick things off with a little bit of a puzzle. How is it possible for two people with the exact same salary and the exact same savings habits to end up in completely different financial worlds 30 years from now? One is doing okay, but the other is truly wealthy. It all comes down to a single choice they make, right at the beginning of their journey.
To make this real, let me tell you a story about two friends, Alex and Ben. They're just out of college, starting their first real jobs. And on paper, they are basically identical. Same education, same paycheck, and they've both got that same drive to succeed.
Now, both of them are great savers, putting away the exact same amount of money every single month. But here, this is where their paths completely split. Alex decides to invest in the stock market. He's aiming for about a 10% return each year over the long haul, and he knows there are going to be some ups and downs. Ben, on the other hand, he plays it super safe. He puts all his money into fixed deposits, or FDs. That's basically where you lock your money up for a guaranteed but much lower interest rate.
So this massive gap that's about to open up between them, it's all powered by one single concept. It is honestly one of the most powerful forces in all of finance, and yet they probably didn't teach you about it in school. We're talking about the magic of the compounding snowball.
So what on earth is it? Well, put simply, compound interest is the money your money makes for you. Just imagine a tiny little snowball at the very top of a really long, snowy hill. At first, it's nothing, right? But as it starts to roll, it picks up more snow, getting bigger and bigger and faster, all by itself.
So how does this whole engine work? It's really just a simple three-step loop. Step 1, you put your money in, you invest it. Step 2, that money earns a return. And then step 3, and listen, this is where the real magic happens. Those returns you just made get reinvested and they start earning returns of their own. This cycle repeated over and over, year after year, that is the true engine of creating wealth.
Okay, so what does this actually look like for our friends Alex and Ben? Let's hit fast forward and watch this 30-year wealth race play out, all because of that one little choice they made when they were 22.
For the first 5 years, you'd barely notice a difference. Ben might even feel like the smarter one, because his money is safe, right? But then, something incredible starts to happen. By year 15, Alex's account is noticeably bigger. And by year 30, whoa, the difference isn't just big, it is astronomical. That little snowball is now an avalanche.
Just look at that. The visual power of that one choice is staggering. Ben's money, it grew safely and steadily. And hey, there's nothing wrong with that. But Alex's wealth, it didn't just grow, it exploded. It's on a completely different scale, totally dwarfing what Ben saved up. This is the raw power of compounding right in front of your eyes.
This reminds me of that famous quote. People often say it was from Einstein. Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. It's so true. Alex understood it, and he reaped those incredible rewards. Ben, by playing it safe and not understanding it, well, he effectively paid a massive price and lost opportunity.
Okay, so does this whole story mean that fixed deposits are bad and you should just never ever use them? No, absolutely not. That is not the no-bluff takeaway here at all. It's all about using the right tool for the right job.
So the crucial point is this. You've got to match your investment tool to your timeline. Fixed deposits, they're perfect for short-term goals. We're talking about anything you need the cash for in the next, say, 1 to 4 years, like a vacation fund or a down payment on a car. Their main job is just to keep your original money safe. Think about it this way. FDs are your reliable go-to for money you absolutely cannot afford to risk losing and that you're going to need pretty soon. They're predictable, they're safe, and believe me, that has huge value for those short-term goals.
But stocks? Stocks are the powerful engine you use for the really big goals. The ones that are 5, 10, even 30 years down the road. Goals like retirement or maybe buying a house someday. For those, you need that high growth potential that lets your compounding snowball really get rolling.
And understanding this fundamental difference, the difference between tools for safety and tools for growth, that is the foundation. It's the bedrock for everything else we're going to build together over the next 49 days. We are just getting started.
Oh yeah, this is just the beginning. Over the next 49 days, we are going to give you the no-bluff guide to everything else. We're going to tackle how to actually understand stocks, we'll demystify the difference between mutual funds and ETFs, show you how to plan for retirement, and even covered the smart way to use loans. It's all about building that lasting financial mindset, piece by piece.
So we're going to end day one with this simple question. Now that you understand this, you've got a choice to make. The decisions you start making today are literally going to determine your financial future. So the question is, which story are you going to write for yourself? We're here to help you figure that out. I'll see you tomorrow.